Regardless of all the mistakes that I've made along my infinite banking journey, and there have been many, infinite banking is still far superior, when done poorly, to conventional finance at its best. Hello and welcome to the Durham Talents Channel. My name is Jesse Durham. I help people live and leave a lasting legacy with the infinite banking concept. This is going to be a talk about the mistakes that I've made along my infinite banking journey. There are many, most of which are personal. I'll share some professional ones as well. This has been really interesting for me to do, to go through and experiment implementing infinite banking for over a decade, going on 11 years now. But going through the experiment, the exercise of actually going back in time, recent and all the way to the beginning, and making a list out of the mistakes, the lessons learned, the hard lessons learned along the way. But again, I'll tell you that infinite banking done poorly, done inefficiently, is so much better than conventional finance, where you're operating with credit or cash. Credit, you're beholden to someone else's terms, conditions. If they qualify you, they hold collateral over your head. You're bleeding out interest dollars in that credit method. And the cash method of personal finance, because again, anything and everything is finance. Nelson says that in Becoming Your Own Banker. I'll reiterate it right here. Everything's finance, credit, cash. If you're using cash, where's the legacy move? Couldn't those dollars have been those that were liquidated for whatever it is that you needed to spend the money on? Where's the legacy move? Do they work anymore for you for future generations? No. What about the cost of capital? What about the cost of acquisition? What about EVA, economic value added? There's so much power. There's so much ability that's lost by only using money once instead of the third C, which is compounding. So conventional finance, credit, cash, compounding is what you get with infinite banking. So let me share some of my mistakes so that you could collapse time frames, improve your trajectory of where you can go sooner, better, faster. The first that I would share with you is that I just showed up to my infinite banking exposure in 2015 when I saw a presentation on the concept with virtually no organization, with virtually no communication with my wife around money. I mean, we worked hard, we were growing as a family, we were paying bills, and yet we had acquired all the traditional debts that most people have. We had student loans, we owed on our family car, we had credit cards with outstanding balances. We had medical bills from our second son recently being born. So we just were not having intentional conversations. We were not budgeting. We were not talking about goals and plans and ambitions as much as I would have liked in an intentional fashion. So I mention that even as simple as it is, because again, what's simple is foundational, it's fundamental. The first half of Nelson's book even is covering the human problem. So we just didn't have a clear vision on where we were, keeping track of things. You know, there is a saying of what you focus on expands, what you track improves. So we weren't doing that, and we were not looking ahead far enough. As a young father, if you would have asked me, Jesse, do you want things to be better for the next generation, for your children and your children's children? Yes, I believed in leaving an inheritance for your children's children, but I did not have a plan on how I was doing that. So I do believe that that is a mistake, not looking at vision, communication, having a plan, putting it in writing, being intentional when it comes to personal finance. The second, and it's a close one, is once I was exposed to infinite banking, it took me longer than I would have liked, and part of that was for different reasons. It took me longer to get a policy. I saw infinite banking late in 2015, second half of the year 2015, and I didn't get my policy until the first half of 2016. But we immediately began making moves and changes. We had that year 2015 made changes to 401k contributions. We even closed out some qualified plans, bit the bullet on the penalties and the fees and whatnot, the taxes. We began making changes to our cash flows. We had a yard sale. We went through the house. We just started looking at things that we were doing. And we did make changes. But still, with all that being said, even though we put things in motion and my wife and I were having conversations and we were having webinars and we were getting further into this book and getting back into it and continuing our learning journey, finding what we could online, it's still, and this is common, most folks that I speak with are going to say, why didn't I see this last year, 30 years ago? I mean, just depending on who I'm talking to and where they're at in life, that's a common sentiment that I wish I would have seen this sooner. But that's okay. We all have to start where the beginning is for us. So what I would say there then, to encourage folks that feel that way, is, of course, we wish we could have started earlier, but once we know enough to know that we want to implement this concept into our lives, let's be about it. So vet, research, do what you need to do to become familiar with this, to understand this enough to know that you want to implement it. But when you do, as James Nethery says, it's all conversation until someone writes a check. And I found that to be true, personally and professionally. And just even this year, within the past 12 months, I've bought 2 more policies, one on myself and one on our 4th child. And these are still things that I wished I could have gotten in place. Now with the child, I mean, before our son was 1 month old, his policy was in force, but there were still, with my other policy that I just got on myself, another policy on myself within the past year, there were still those feelings of, I should have done this sooner. But here we are, lessons learned. Starting too big. This is a mistake. I say it's a mistake for me personally, even going all the way back to my first policy, and yet it's not. So here's what I'm saying. My first policy, I believe, depending on who you ask, could have been a bigger premium than it should have been. And I've got a video on how I coach folks through a few methods. It's not all inclusive. It's not totally comprehensive, but I run through a few different methods of talking about premium, prompting folks, potential clients, prospective clients, on how to think about premium in a video that I can put down in the show notes below. How much premium makes sense for you? And I don't tell clients that number. I wasn't told that number, but there are some helpful things around premium and what might be appropriate for you in that video. So I will put a link for that video on premium in the show notes below. But looking back now, I could say that that premium, even on my very first policy, very well could have been me biting off more than I should have been trying to chew, especially at the beginning, perhaps especially at the beginning. Now, of course, that I'm coming up on the 11th year of owning and using that policy, I'm so happy that it is the size that it is and that I made it happen to start with that size of a policy. Now, there's going to be something here that I'll mention as another separate mistake, but I'm talking about total premium that I dedicated and planned and scheduled to pay for that policy, depending on who you ask, could have been more than it should have been. But of course, now I'm glad that it is what it is, because we made it happen to prioritize our cash flow to go to policies before anywhere else. We prioritized paying ourselves first, and we did so by paying premiums into policies. So I would say that it is possible to start too big. It is also possible to start too small. Between those two, I would rather, working with clients, have a client start too small and then us grow and scale from there, rather than start too big and feel like we are in a financial strait. But again, this of course would go all the way back to prospective client consultations. I have multiple consultation calls in my process of onboarding potential new clients. And this is something that, again, I don't tell folks their numbers, that they tell me. I take a full look at a client's or a prospective client's financial footprint before I say that, okay, I'm okay doing it this way, and we're building out that policy with lots of flexibility. But all that being taken into account, consultation calls, looking at your complete financial footprint. What are your assets? What are your assets and your cash flows and your debts and your expenses? What all these, your plans, your goals, what do all these things look like? Even with all that being said, it is possible to start too big. It is possible to start too small. So I feel like that's a mistake that I needed to mention. And again, I believe that the remedy to that is being very familiar with this concept, being very familiar with your financial footprint, leveraging and utilizing the best practices and experiences of the professional that you are going to be working with over your lifetime. And the majority of problems can be avoided with picking a premium that's too small or too big. Now, that doesn't negate that Murphy's Law exists. Now, Nelson famously talks about Parkinson's Law, which is the tendency to spend all that we earn, but Murphy's Law, where, well, if something can go wrong, it's likely to go wrong. Okay, Jocko Willink says the enemy gets a vote. Okay, some things are very much so out of our control, but there is so very much that we can do to make sure that premium is appropriate for each individual case. This is an avoidable mistake. Now, a very close mistake to what we were just talking about with premium sizes is going to be concerning that flexibility that I mentioned on premiums. So when a policy is optimally designed, there should be a very healthy amount of flexibility when it comes to premiums, meaning that, sure, there is this regular scheduled premium that a client will have where you're going to be paying whatever you've chosen, monthly, quarterly, semi-annually, or annually, okay? And there should be, or there certainly can be, flexibility when you have additional cash flow, funds that you would like to build into the policy, that you have that upside ability, that upside flexibility to pay more, to pay above and beyond your regular scheduled premiums. Also, when a policy is designed for infinite banking purposes, there could be the ability for you to pay much less than the total scheduled premium that you normally would pay in the event of some exigent circumstance. Or perhaps another example would be later in life when you're ready to use a policy or a system of policies for passive income. You may reduce down to just paying base premiums and the necessary premiums for riders that you have on the policy, but without maximally funding or even up to the scheduled amount, the regular scheduled premium of the policy. Now, I say that about the flexibility to say that every company is going to be a little different. Contracts are going to be different. You should be familiar with your contract. With my first policy, I had variable premiums that I paid in the first few years of my policy. And some policies have more flexibility than others. So again, be familiar with yours. But I've experienced this personally with one of my policies, to where in the first few years of a policy, I paid varying amounts of premium into the paid up additions rider of my policy. And if you need more information about the paid up additions rider in particular, I can also put in the show notes my video where I talk about the paid up additions rider in my EncycloMedia Series. So check that out if you need more details there. But it's a flexible portion of the policy. It's a flexible part of a properly structured policy is this paid up additions rider. But some contracts will say that, well, okay, if you pay your regular scheduled amount, but then the next year you pay less, or the next year you pay more. Well, there may be a stipulation in your contract about, well, okay, well, we're going to take the average of your past 3 years or your past 5 years or whatever the contract says, years of premiums, and the next upcoming year, you'll only be able to pay the average of what those 3 years were. Okay, so do you understand? So if you started out, real world numbers, if you started out being able to pay $6,000, and this is my case, I'm just sharing you my mistakes, $6,000 can fit regularly scheduled into the paid up additions rider, $10,000 total for the policy. $6,000 got reduced to $5,040 on this particular policy that I'm mentioning. That is the upper limit now on that particular policy. Now, do I have a portfolio of 8 policies? Yes, I do. Which does that policy upset. No, that's still my favorite policy. That's my oldest policy, and it's my favorite policy. I've done a lot of privatized banking with that policy. Do I also still wish that I could fit in that extra about $1,000 in premium into the paid up additions rider every year? Yes, I do. So again, be familiar with your policy contracts and maximize it to your ability every year is my suggestion. On that note, I do actually have for my clients and for the general public currently a video available where I talk about best practices for annual reviews. So when you come up on a policy anniversary, there are several things that I think you should be looking into. Do you need to change? Do you need to alter? What can we maximize? So I could put that video in the show notes below as well. It's something that should be regularly, annually visited, I believe. And that's one of those nuances is let's keep the ability to pay as much premium as possible into the future. But again, the silver lining is that the idea here is to build a system of policies over a lifetime to be able to eventually account for 100% of your need of finance. But that's a personal mistake that I wish could have been different. It's given me a great lesson learned, though, and it's certainly not stopped me from being a better and a better infinite banker going on 11 years now. Another mistake, or inefficiency at least, is one that I've actually already alluded to. I said earlier that in the past 12 months or less, I've actually gotten 2 more policies. Well, one of those policies was a convertible term policy. Again, I can't help but reference. If you need more information about convertible term policies, I have a video from our EncycloMedia Series on convertible term. Make sure to check that out in the show notes below if you need that information. But one of those 2 policies that I bought was a convertible term policy on myself. So I had more insurability that was available to me. And as I turned 40 this past year and our fourth child was born, I had those couple of life events that was making lights go off in my mind saying, hey, I need to up my security. I need to up my protection. I need to level up what I have in place on myself. But I have several whole life policies that I'm already doing plenty of banking with. So convertible term was a great option for me that allowed me to acquire my actual, at that time of application, my full human life value. So human life value, again, another term within the insurance industry. I've got a video from the EncycloMedia Series on human life value. Check that out in the show notes below if you need that one. I actually could not get more insurance at the time of this recording. I got all of the insurance that I could buy on myself, and I did it with a convertible term policy, one that I'll be able to convert to a properly designed and structured whole life policy in the future, guaranteed. Lots of benefits there, but that whole concept of human life value and acquiring it sooner, I wished I would have done that 10 years sooner when I got my first whole life policy. So I would just go ahead and tell you, it's a very common in my practice of working with clients. I had a consultation call today. Client got approved for 2 policies. One whole life policy to begin infinite banking with. We could this year right away be using that policy for her goals. But the second policy that she was approved for and wants is a convertible term policy that's allowing her to acquire more of her human life value. So I wish when I was 30 and was getting my first whole life insurance policy, I wished I would have known more about human life. Oh, I wish I would have known about human life value. I didn't know how much I was eligible for. So it's common practice for me now to recommend that someone consider getting both. That way you're maximizing your protection sooner rather than later while you're younger, healthier, but also you're getting started with infinite banking by getting a whole life policy to begin privatizing your banking using that whole life policy for that banking function at the same time. It's a very common practice, but that's one that I wish I would have learned about sooner and implemented sooner in my own personal life. So I certainly point that out regularly to folks now. I want to show you when we're talking, okay, how much insurance? I don't care if it's work insurance. I don't care if it's insurance that you already have. It's not designed for infinite banking, or what we're looking at proposing that you consider acquiring for yourself I want you to know, okay, well, if you're eligible for this, how much have you already acquired of what's available, what's on the table for you? Do you have 11%? Do you have 37%? I mean, in the vast majority, the vast majority of us Americans, it's less than half. It's such a small number. And I believe that we need to be considering acquiring more protection and guarantees for ourselves by acquiring that human life value as soon as possible. Another error that I made along the way that I work with clients on avoiding is not running your privatized banking system with enough reserve capital. So my example is when I got my first whole life insurance policy and I was going to implement this infinite banking concept, debt was my number one goal. We had the family car, we had the credit cards, we had the student loans, we had those things that we wanted to pay off. So I was putting as much premium as I could into that policy, and I was taking max loans right out of the gate. Now, I'm not saying don't do that. Here's what I am saying. I would encourage anybody to operate remembering Nelson's golden rule from the book. Remember, he who has the gold makes the rules. So I found that two things come to us in life, whether we want them to or not. Two things: obstacles, opportunities. So what I've seen in my own personal experience and in my professional experience is that if we are full bore, full tilt into something like debt recapture, again using my example, if we're taking max loans and we don't have some separate emergency fund, war chest somewhere, and some obstacle shows up or some opportunity shows up, we don't have any buffer. We don't have any gold to be in a powerful controlling position. So again, I don't tell people their numbers. I would ask you to consider, is there some absolute number? I mean, do you need $1,000? Do you need $10,000? Do you need $100,000? What do you need to have as reserve capital, as an emergency fund, as a war chest to keep the wolf from the door, so to speak? Even if you're very aggressively pursuing acquiring business equipment or your next property deal, or you're paying off debt and recapturing that for yourself, whatever it is that you're using policy loans for, I now would counsel everyone to consider having dry powder, having reserve capital to whatever degree is going to make you comfortable that if some obstacle or opportunity comes, even though you're aggressively pursuing whatever it is that you're doing, you still have enough to weather a storm or what have you. That was something that I've experienced personally myself. I wished I would have had some buffer. I wish I would have had some reserve capital, again, for obstacles and opportunities. My suggestion is perhaps you keep what I call 15-minute money, something in a checking account, something in a savings account, something under the mattress, right? And then you have 15-day money, right? Money that you do not leverage from your policy contract, okay? You don't take a max loan. So perhaps a combination of those two things, having some cash on hand, having some reserve capital that you've not leveraged via policy loans. So some of those, so both of those or one of those or the other, whatever makes sense for you, but operate with dry powder. Operate with some reserve capital. Another mistake, you could even say regret of mine that I have, is not reaching out sooner, more often, and to more people about their own experience with infinite banking once I was exposed to it, and even once I had implemented the concept. I saw infinite banking in 2015. So here's my example. Nelson didn't graduate. He didn't go to meet the Lord until 2019. I had 4 years of opportunity where I could have written a letter, where I could have tried to make a phone call, where I could have made it to a think tank, to shake the man's hand, to hug him, to tell him a thank you for the work that he did in discovering and then codifying this concept in his book and in his Nelson Nash Institute. So that's a personal regret of mine. I did have the ability and the advantage of speaking with a couple of folks who had already implemented infinite banking once I was exposed to it, but I didn't have a lot of in-depth or regular conversation with those folks. So I believe my own experience could have been improved by having more and regular intentional conversations with folks who had been further along in their own personal journey. So that's my encouragement. And of course, now here I am speaking, and this video is going to be on YouTube and all the other platforms to where I am sharing best practices. I'm literally telling you about the mistakes that I've made and trying to point you out to ways to avoid them so that you can collapse time frames and speed up your better experience that can be had. So I hope that this is well received to that purpose so that you don't have some of those same regrets that I do. But that's one that I happen to have. Would have loved to have met Nelson. I'm very thankful to have met David Stearns, Kim, his daughter, Nelson's daughter, David's wife, to have been able to meet Lee Barganier, Carlos Lara, Nelson's good friend. So I've been able to meet a lot of great folks that did personally know Nelson. I just actually recently got back from Think Tank 2026. I'm an authorized infinite banking concept practitioner as of 2025, but I just received my certificate at the Think Tank here in 2026. So I am thankful to have met folks who did personally know Nelson. But I would encourage you to have more and regular conversations with whoever it is that you're already working with, and also within your family, also within your circle. You know, Nelson did encourage us in the Becoming Your Own Banker book to have a mastermind, to have a club, to be actively and intentionally involved with a group of people that were looking to better themselves in general, not just with infinite banking, but in general. So I would encourage everybody and admonish you to consider the same. And while I do mention about becoming an authorized practitioner, I need to say that that is a professional regret or mistake that I have made. I felt like I had to earn or work my way into the community. It's a very receptive community. I've actually made a video on my experience of what it was like to be personally practicing infinite banking and then transition into professionally helping folks implement the concept, and then what it looks like to come into the fold, as it were, to become an authorized infinite banking concept practitioner. I've actually since been interviewed on the Infinite Banking Initiative podcast, where I'm speaking to David and Lee about that journey. I can put that link down in the show notes below. But I do, being in the community now, wish that I would have been here sooner. Wish that I could have met these folks. But again, I'll couple that with my overall sentiment as well, that the journey is what it is now. Of course, there's no point in crying over spilled milk. But again, I'm taking you and your journey into account to say some of these things, and not just for reflective purposes myself, introspective purposes myself, because I want you to have the best experience that you can have. But that's one that's occurred to me along my journey. I wished I would have come into the practitioner program sooner, joined this community closer sooner. And I'll say it again here, even though I've said it in other places, that I'm grateful especially to Bruce Weiner, my good friend, that was so intentional and proactive in inviting me into the community. So thank you, Bruce. Policy loans. Running up policy loans. Stealing the peas, as it were. Now, I will say there's a difference between stealing the peas, having no intention, no plan, no honest integrity when it comes to treating a system of policies like your privatized banking system. Okay? There is a flow to and from banking systems. There's a difference between stealing the peas and operating over a time frame, even if it's a long time frame. I mean, my goodness, if it takes you several years to get into whatever level of debt you may be in, mightn't it take you a while to get out? Yes. So that's not necessarily stealing the peas. And I talk with folks who struggle with this. Well, Jesse, if I pay premiums and I have a cash value and I leverage that cash value from my policy, take that policy loan, go out and pay off one of my debts, don't I have to pay that back? Shouldn't I pay that back? Oughtn't I to pay that back? There's your good redneck word. Oughtn't I? Yes. But do you have to right away? No. Couldn't you just jump over to paying off the next debt if you have more debts to pay off? Is that stealing the peas if you just go and tackle the next debt now? No, absolutely not. Absolutely not. Get the leeches off of you. Get those money suckers off of you, right? So just because you don't pay a policy loan back the next day after taking it doesn't mean that you're stealing the peas. And again, this is coming from someone who has had six-figure outstanding policy loans. I've done this at a high level, y'all. I've paid hundreds of thousands of dollars in premium over the past decade plus, okay? I have had outstanding balances of six figures. Okay, I've done infinite banking at a lifestyle level. We've got 8 policies currently. That number will continue to grow and change, God willing. But I will mention this just because it's relevant for all of us. Doesn't matter if we're in the beginning stages of implementing the concept or if we've already been implementing the concept for a decade. We always need to be thinking about being, and act this out, an honest banker. We need to have a plan for policy loans. We need to have structure for policy loan repayments as well. And again, I'll say that doing infinite banking poorly is still a far cry better than conventional finance done normally. Because just by changing that one step of where we prioritize our cash flow to go to, just by doing that, and even if we are max loaning from the values of our policy, even if we are continuously for a given time frame, a given period. And again, I'm not here to tell you what that time frame is. And in fact, if we walk out infinite banking and we get to that passive income time of life, I mean, the idea is to have outstanding policy loan balances on a system of policies when we pass, because that's where we can be supplementing our passive income from. I mean, there are going to be ages that I'll get to, and if I can still pay premiums, I'm going to be paying premiums out of pocket. But I may be, of course, not even doing that and just be receiving cash flow because I own those policies, whether that's through dividends, surrendering paid up additional insurance that I've bought, or I could withdraw up to the cost basis of the premiums that I've paid, and then I can be switching over to policy loans. So I can be having a tax-free cash flow to me from a system of policies that I have no intention of paying policy loans back on, because when I graduate, even when there are outstanding loan balances, and yet also this death benefit that exceeds those loan balances, our children, the beneficiaries, whether church, charity, or children, whoever all is there, is going to be receiving that income tax-free windfall, even though I had outstanding loans going on right there at the end of this life. So all that to say, be structured, have a plan. It can be a grave mistake to unadvisedly, recklessly run up policy loans, especially so if we're still going to go out and run up other debt elsewhere. Still be financing our cars with the banks and bleeding out interest dollars there. Still running up account balances on credit cards that we're not paying off, okay? So I'm not saying be irresponsible. I'm not saying be reckless. I am saying that infinite banking is the best way to finance, and I am saying we should manage our policies well. And everything that I just said there concerning policy loans includes policy loan interest. I'll give you my framework. My framework on how I prioritize cash flow to my policy is I want to pay my regular full scheduled premiums on all of our policies. I want to pay as much additional premium as I can into the paid up additions riders on those policies. That's my next priority. I want to pay policy loan interest, even if I'm running outstanding loan balances for X, Y, or Z, business, investments, paying off debt, whatever that I'm using policies for, that you're using policies for. I would suggest you consider paying off the policy loan interest each year so that that doesn't compound into the outstanding policy loan balance. And then ultimately, of course, restock the shelves with the P's. Pay off our policy loans, refill the reservoir. Okay, so pay premiums, pay extra premiums when you can, how you can, as much as you can. Pay the policy loan interest and repay the policy loans are how I prioritize and encourage folks to consider prioritizing cash flow to policies. But if you don't pay the policy loan interest, it's simply going to either have been pre-charged before you take a policy loan from certain insurance companies, or it'll just be added into the outstanding loan balance. But it is something to avoid when you can. Now, another mistake that I reflect on is not getting policies on children earlier. Again, on our own children, and I convey this to clients and prospective clients. So actually, I had whole life insurance that I privately went out and bought for me, my wife, and our firstborn son, still when I was a teacher in the state of North Carolina. I went out, I guess being a new father, I was compelled to take some initiative and protect the family in that way. I went to a mutual company and bought whole life insurance. Interestingly enough, prior to knowing about the infinite banking concept. So I felt that impulse as a young father to go out and do that. When I learned about infinite banking, we started changing how we were doing finances, and we did prioritize getting a significant policy on myself. And then it wasn't but about 8 months later, and we got a significant policy on my wife. But we were putting so much premium into those two policies within that first year of beginning to buy policies and implement infinite banking that it did take some time after that for us to get some of the snakes and dragons, as Nelson would say, to pay off the family car, to pay off student loans, to pay off some credit cards, before we did then get policies on the next generation in our household. So if I could have done that sooner, I would have liked to have. And that's just another one of those things. When would you like to have a big, beautiful tree? Okay. Well, the options, of course, are, well, if you didn't plant a seed 30 years ago, 50 years ago to get to that big, beautiful tree, today's the next best day, right? So when you know better, you can do better. But it took us time. It took us some years of implementing the concept to get policies on our children, but we did. And again, even now, when we got policies on our first three children, our fourth was not born yet, those policies even look different. The fourth policy, the most recent child policy that we got, late 2025, is better structured even than those first three. Now, has that stopped us from doing banking with our older children's policies? No, we've done all kinds of banking with those policies. In fact, our children have been doing family banking with us for years. I have a whole series on our channel. It's called the Family Banking Series. If you've not seen me sitting down with our children, talking about money deals that we're doing, talking about savings, talking about capitalizing, talking about assets, talking about cash flow, I would encourage you to check out our Family Banking Series. I can put a reference for that in the show notes below as well. But I have learned better, so that should be one of my, it's probably on here, regrets or mistakes that I've made along the way of I should have learned more about, so I'll go ahead and say it, I should have learned more about the product flexibility, the product's ability, because there are riders, there are attachments that we've put on our most recent child's policy that didn't get put on our other children's policies, and I wish they had been built that way. Now, has that stopped us from banking with them? No. We've done a lot of banking with them. They have a lot of wonderful features built onto them. But are there one or two things that I would have changed and added? Yes, absolutely so. So being familiar with the ability of your product, I do think is very important. And that's going to go back to it matters who you work with. Is that person dealing with the arrival syndrome, or are they fighting off the arrival syndrome and growing and improving and getting better? I would like to say that that has certainly been my personal trajectory and my professional trajectory, that I have continued to grow, to learn, to improve, to connect, to dig deeper into more and more levels of implementing this concept and understanding this product. Yep. So that was going to be the next mistake, that I have not utilized all the riders that I wish that I would have. So again, I do think that our EncycloMedia series is going to be a big source of help when it comes to those additional riders. Make sure to check out that playlist in particular. And then another mistake that I have reflected on is not understanding the difference between direct and indirect recognition companies and contracts earlier. So again, I've got an EncycloMedia video on what that is, direct recognition versus indirect recognition, or non-direct recognition. My preference is non-direct recognition. Now, I own both types of contracts from two different kinds of companies. One's a direct recognition company, one's a non-direct. I've banked with both of them. That's not stopped me from banking. But also, at the same time, have I seen a difference in performance of those contracts because of how I've used them? I'm not taking me out of the equation here, okay? The human element, how I've used them, but also just how the contracts naturally function. I prefer the non-direct. I wish I would have known about that earlier. Has it hampered me? No. Is it a difference? Yes. So I'll mention it here so that you can get educated and figure out what best suits you. Whether you're vetting this concept or whether you've already implemented the concept, and maybe that will change how you continue to build out a system of policies over your lifetime. Here's one that I'm not satisfied on even today. I do believe that it's a mistake for us not to look up the family tree. I know it's very common for us to, and we should, begin with ourselves. I believe we should lead by example. Us parents, us husbands, wives, those of us that are seeing this concept, deciding to implement this concept, we need to start by getting policies on ourselves. I believe that's the starting point. Unless you are legitimately uninsurable, and even if you are uninsurable, there are other steps that you can take, of course, to implement infinite banking. Hey, have I mentioned my EncycloMedia series? I might or might not have a video on uninsurability and what you could do about that. So I do. I'm being facetious. I have a video on it. I'll put it in the show notes below. Hey, y'all, just watch more on the channel. There you go. But I'm trying to be organized for you. So it's natural for us to start on ourselves, and then it's natural for us to think about our children, the next generations, or grandchildren, if we're grandparents. But looking up in the family tree is also a very prudent thing to do. That generation is obviously closer to mortality. And if we can get protection in place and products in place that would help the generation that precedes us to have advantages, even if it comes to, heaven forbid, them having terminal illnesses, chronic illnesses, need for long-term care. Of course, having life insurance for its protective legacy move in place, but also the grandparents are driving cars and giving gifts and taking vacations, and we're all financing. So again, it can be an error, it could be a mistake not to look up the family tree, and hopefully sooner rather than later. Now, this has to happen when it makes sense for you, depending on your cash flows, depending on your priorities, depending on what's possible in your situation. But the sooner we can think about building a system that spans multiple generations, the better off we are. So getting policies on parents, or having parents get policies on themselves sooner rather than later, is advisable. And then the last mistake that I'm going to mention before I give you some suggestions on how to improve your trajectory, the last mistake that I would mention is not having regular, in-depth, detailed, ongoing conversations with your financial professional. This is something that I personally did not do enough of in the beginning. I recognize that now. I was doing a lot of self-study, but I also don't know what I don't know. So I was reading as much as I could get my hands on about infinite banking. I was watching as much as I could, but I do reflect now and see where there was a void, where it could have been better, where I could have been having more one-on-one conversations with my agent. I implemented the concept for years, just as a fellow looking to implement the concept before I became the professional myself. So I know that would have been a boon to me to have more regular, in-depth, ongoing consultation calls with my agent. Now I handle that religiously. I have annual reviews with clients. I have open access for messaging and calls and Zoom calls and multi-generational family banking calls. I love those where I'm talking to 3 generations in a room at once. Beautiful, having those virtual calls with multiple generations at once. I use a financial footprint document for my consultation calls. At the time of this recording, you can get it at durhamtalents.com. You can get it, you can download it, you can use it, and it's what I use in consultation calls so that we do keep things dialed in so that I can share best practices according to where you're at in your financial footprint. We need to be dialed in on what are your goals and what's the best way to go about facilitating the accomplishment of those goals. So you have not because you ask not. My encouragement, my admonishment to everybody is reach out, be proactive. Your agent doesn't know what's in your mind. You've got to send a text message. You've got to get on their calendar. So I would encourage you to do that. You wouldn't withhold information from your doctor and still expect your doctor to give you a great recommendation. They're going to have you stand on the scale. They're going to ask you about medications. They're going to do this, that, and the other to have a holistic idea of where you're at. And then, of course, you need to talk about where you want to go. So do that with your financial professional. So there are plenty of errors, I'll bet, that I have not noticed or that I am forgetting or that I've not even committed yet. So my ask here is, have you had a great takeaway? Something that would be helpful for us? Put that in the comment section below. If you have a question about something, put that in the comment section below. And then here are my helpful takeaways to you. To avoid most errors, just consider Nelson's principles. Think long range, capitalize intentionally, be an honest banker. Don't do business with banks. Rethink your thinking. Prepare for windfalls and share this concept with those that you care about. If we'll implement those principles, we're going to avoid a lot of mistakes. Review the book regularly. If you've not watched the documentary on Nelson, if you've not watched Nelson's seminar, if you've not read his second book, Building Your Warehouse of Wealth, these are all source original materials that I would encourage you to revisit. Form a mastermind like Nelson encourages us in the Becoming Your Own Banker book. Have family meetings around infinite banking. I'm happy to help facilitate those if you're my client. And again, IBC done inefficiently is so much better than conventional finance. So this has been an absolute pleasure for me to share my mistakes along the way, and I hope that you have benefited from this conversation. If you'd like to connect with me, you can find me at durhamtalents.com. It is my hope that you live and leave a lasting legacy.